we go.
I always ask you to click when the recording is in progress. Got it. Or leave. So people are still joining, but welcome to everybody who is here. It's great to see you all. So I think we're just going to start. It's 11:01 New York time. We're going to be on time. It's middle of the night for our guest, Richard, who is kind to join us from Sydney. So again, welcome everyone. Those of you who don't know me, my name is Katya Malinova. I'm with the DeGroote School of Business in Hamilton in Canada. We're very pleased to have with us today Richard Phillip, who is again joining us from the University of Sydney. He'll talk to us about machine learning in the dynamic limit order market. The rules of the game are we have about a 45-minute seminar. So Richard will speak for about 45 minutes. He'll take 2 question breaks throughout the talk. We also have the chat enabled. So if you have questions throughout the talk, please post them in the chat. And if you have very burning, clarifying questions, then you can also ask them during the talk, but we'd prefer to take the majority of the questions in the breaks so that we can have the seminar run smoothly. And now, Richard, the floor is all yours. Thank you very, very much again for joining us.
Okay, let me just share this screen. Okay, screen shared. Okay, so I guess I'd like to obviously start by thanking the organizers. You know, there's an old saying that when life gives you lemons, make lemonade. And I think the organizers certainly put a nice spin on that of when life gives you COVID, make the microstructure exchange. But I think this has been a pretty nice, positive kind of spin from a pretty negative situation. So I think we all owe you guys a big thanks for this. So as I said, I'm kind of thrilled to be here today to present this paper titled Machine Learning in the Dynamic Limit Order Book. And this paper has actually kind of been on my mind for over a decade, which is sadly showing my age. In a former life, I used to work as a high frequency trader, and you know, questions that I was always asking myself is obviously, when should someone try to buy or someone try to sell? But once you've made that decision, how do you do that? You know, do you use a market order or do you use a limit order? And if you choose to use a limit order, at what price should you submit your order? Should you submit it at the best bid, 1 tick behind the best bid, 2 ticks behind? And once you've chosen what price to submit that limit order, when should you cancel that order? Should you cancel it at any point of time and submit it to a different price level? So those are the kind of questions that I was always thinking about. And in essence, it sort of stems down to which order is going to make the highest expected value. And so as it turns out, it kind of sounds like a simple question to ask, but actually a kind of difficult question to answer. And that's what I'm going to try to hope to shed a bit of light on today. As I sort of say, these questions are kind of pretty important questions that almost every trader faces. So if you want to go and buy some equities, you want to trade futures, options, crypto, you're going to face this type of problem. So it's pretty important for all the sort of practitioners out there, but it also becomes quite important for regulators. So we see regulators imposing things like minimum resting times, capping order to trade ratios, you know, and if regulators don't understand how traders should optimally manage their orders, these types of restrictions could prevent people from being optimal. So given that kind of importance of the problem for both practitioners and regulators, you know, academics have sort of obviously come to the party to help try to shed some light on this and to give some answers to this question. And that's largely been done through the theoretical literature. Okay, and these theory models are really complex. And I think it's important to try to test them to see if some of those predictions hold up on empirical data, where maybe market participants aren't quite as rational as we would all expect. So that's kind of the first motivation of this paper, is to test some of those predictions made by theory. And another motivation is you'll see that the technique today can help us with another question. And what we see is there's this potentially an option to cancel an order. And that's kind of been relatively unexplored in the literature. So if you think about a limit order, you've always got that free option to cancel. You can cancel it at any time, almost at no cost. But we all know that options aren't worthless, right? So somewhere there must be some embedded value in that option. And what I'll try to do today is tease out, well, if you've got that option to cancel, how much value does that add to the expected profit of your order? So what I'm going to do today is I'm going to propose a machine learning technique that allows us to estimate that expected profit of a limit order. Okay, and not just the expected profit, there's a caveat there that it's going to be based on the current market conditions or what the world looks like, and also the expected profit conditional that it's then optimally managed over its life cycle. Okay, and what that allows us to determine now with those expected profit estimates is it allows me to work out where to place an order, to place where there's the highest expected payoff. It also allows me to monitor that order and work out when should I cancel it if the expected payoff becomes negative, or if it becomes more profitable to cancel it and submit it to a different price level. Okay, what we'll see is the advantages of the technique I use, which is called reinforcement learning, is I can somewhat remove the black box nature that ML typically suffers from. And you'll see as a result, we can sort of tease out what are the important variables in that decision-making process and their economic meaning. And that, as a result, allows me to test these predictions by theory. Okay, so as I sort of said, most of the questions about how to manage or optimally manage a limit order has really all come out of the theory papers. And when you look at that theory literature, there's sort of 4 key variables really pop out as being key to that decision-making process. So the obvious one is, what price should you submit your limit order? Okay, and there are 2 opposing forces coming into play there, that if you submit your price many ticks away from the best bid, the advantage of that is, like if you're working a buy order, many ticks away from the best bid is the big advantage there is if you get the fill, you're probably going to get a pretty favorable price. You're getting price improvement there. But that comes at the cost that the further you are away from the best bid, the lower the execution probability. So there are these 2 opposing forces that if you're aggressive and you post aggressively, high execution probability, but not a great price. Next variable that really kind of pops out, or the next factor that limit order traders should be considering when they're working out how to manage their limit orders is the shape of the order book, or the size of the queues at the different price levels. Okay, and that was sort of best seen in Christine Parler's original paper, and that's come out in a lot of theory papers subsequently, that this is clearly important for limit order traders when they're considering that decision. Next thing that comes out is queue priority. Okay, so it's very similar to the supermarket. You go down to the supermarket. If you join the back of a giant queue, you're never that happy. If you join the back of a queue and you slowly get to the front and you look behind and you see everyone waiting behind you, you feel good about yourself, right? So same sort of logic here, that the further up the queue, typically that should be better for you. And volatility is, I guess, a last factor that this audience would all kind of be aware of, that there are these 2 opposing forces coming out with volatility. So if volatility goes up, you know, that price can move even further around, and you've got a bigger chance of sort of getting picked off and losing money. So volatility goes up, expected profit of the order could go down. But the good news is we can react to that higher volatility. We can widen the bid-ask spread, and hopefully that could potentially increase our expected profitability. So there are, again, 2 sort of opposing forces that come out there. So as I sort of touched on before, the big contribution now is trying to look at those factors and seeing how relevant they are. So I'm going to propose this empirical estimation technique that allows us to test those theoretical predictions. And what you'll see today is that there will be a bit of a sort of simple framework there. And I sort of want to try to emphasize that try not to think of this as some equilibrium theory model. Okay, so there's no gains from private trade, no assumptions about cross on arrival rates or anything like that. So I guess try not to think of this as a theory model. Just think, rather, I'm just going to try to impose some structure just by the way of the ML technique that I use, so that it's not a black box ML and we can tease out what economic variables there are. So the best way to sort of think about what's being solved today is, given there's a set of empirical data, and you only have a small view of that empirical data, which are the factors theory have identified, what's the best way to manage that limit order? So if you're a limit order trader and you can only focus on those factors that theory identify, what's the best way to manage your limit order? And you'll see that it's pretty, estimation of this is pretty straightforward, and it allows us to then tease out how important these variables are. Okay, so that's the first contribution. And as I say, the second contribution is looking at that option to cancel and how valuable it is. Okay, so the key findings that pop out from all of this is, first of all, we see that Q priority is advantageous as an example of some of the predictions. And what we see is that the benefit of that Q priority becomes more pronounced as your order moves closer to the best bid or the best price, okay, where execution is most likely. Okay, and this is kind of true for all variables that we look at, is the closer your order is to the best bid or offer, the more important that variable becomes. And intuitively, if you think about this, it makes sense. If I have an order 5 ticks away from the best bid, is Q priority that important? And probably not, because 5 ticks away, there's a very low chance of getting execution anytime soon. So if I'm at the back of the queue, maybe no big deal, because by the time the market moves towards me, where execution becomes likely, as that time passes, people could be joining me behind my price or joining the back of the queue behind me, and people could also be canceling in front of me. So where my position is in the queue when I'm 5 ticks away becomes less important. Whereas if I'm at the very front of the queue, if I'm at the very best price, at the best bid, my Q priority becomes really important. Okay, and we see that same sort of effect on all the variables, that the further we are away, it really dampens the importance of them. Okay, other sort of things that pop out, larger the queue size or the more volume behind you, behind your order, or at price levels behind you, then the higher the expected profitability. And the flip side, the more in front of you, at price levels in front of you, then the lower the expected profitability. Okay, volatility, we get that mixed result that I talked about, that there are these two opposing forces. You will see these results. So I'll highlight a few key subtleties that pop out of the data as well. The other thing, as I said, is that option to cancel. And what it turns out is about 15% of the expected value on average of a limit order is due to having the option to cancel. And as an example, for about a quarter of the states that we look at, if you don't have the option to cancel, the expected profit of that order is negative. You're likely to lose money. But as soon as you bring the option to cancel in, the expected profitability becomes positive for about a quarter of the states. Okay, so they're sort of the key findings. Okay, so the technique that I use, as I mentioned, is called reinforcement learning. Okay, and just to give you an overview, reinforcement learning basically has 3 concepts. We've got what we call states. They describe the environment that the agent is in. Okay, so in this instance, it's going to basically be the market conditions. So this is going to describe the market conditions of the limit order. The actions the agent can make. In this case, it's going to be they can leave their order or they can cancel their order. And the reward is typically, an immediate reward that the agent gets when they take an action. And in this case, it's going to be the profit. Okay, so the goal of an agent in RL is basically to choose the optimal action when given the current state they're in. So pick for every state, what's the optimal action to take so that they maximize their total expected future rewards. If you sort of look at the equation, the way to think about it is pi is a policy function that basically determines for every state what's the best action to take. So we're going to pick the policy function that maximizes the sum of all of the expected returns you get over time. Okay, so every incremental step, you're going to get some potential payoff. You want to sum them all up over time. Okay, so a good way to think about this is a very simple game. Imagine that you're this person in the middle of the grid, and this game is going to last for 5 steps. So you can take steps to the left or steps to the right. So if you're going to play this game, okay, and maybe you're short-sighted, right? You want to make a quick buck. So you say, hey, look, there's $1 right next to me. Let me go pick that up. So you take one step to the left, you pick up your $1, you feel proud about yourself, but now you want to have to go and try to pick up the pile of cash, but you've only got 4 steps left. So as you go across your 4 steps, you pick up nothing each time, the game's over, you made $1. So this is kind of suboptimal. Whereas if you can recognize, if you're in this current state, it's not optimal to step to the left because it means you forego the pile of cash. It's optimal to step to the right. So you'll take your step to the right, pick up nothing, but keep stepping to the right, picking up nothing, take your 5 steps, you get the pile of cash. This is what RL will work out. It will work out whatever state you're in, is it optimal to turn to the left or the right? And it will work out, it's always better to go to the right, even though you're getting nothing, because at the end, we're summing up that the total payoff, and the total payoff will be higher because you get the big payoff at the end. Okay, and you think about this is kind of similar to a limit order. Nothing's happening. You've got a limit order sitting there. Nothing's happening, nothing's happening, nothing's happening. And then eventually you get the payoff. Okay, so we can see conceptually maybe how this makes a bit of sense for a limit order. So to hammer that into a bit more logic for a limit order trader, imagine that we have a current limit order book that looks like this initial state here. Okay, so imagine that the rectangles are bids at 11, 12, and 13, the white rectangles. The gray rectangles are offers at 14, 15, and 16. Imagine the size of the rectangle reflects how much volume is available at each price level. So we see a lot of volume at price level 15, a lot of volume at the bid at offer at 15, and very little volume at the bid at 11. Okay, so that's the shape of the limit order book. Now imagine that you've got an order, this black box, at price 12 at the back of the queue. Now the question that we want to answer is, what is the expected profit of that limit order? Conditional on it then subsequently being managed over its lifetime. Okay, so if that expected profit's negative, you probably want to cancel that order. And if it's positive, you want to leave it there. Okay, so that's what we're going to try to have to work out is what is the expected profit. So just as a heads up, in the next slide, I'm going to refer to that as a Q value. Okay, so just for notation, that will be called a Q value. Keep in mind for the next slide. Okay, so how do we work out expected profitability, expected value? You guys, all as finance guys, know this is easy. It's just the probability of all the possible outcomes times it by their respective payoffs. Okay, so if we consider this oversimplified model, we could transition to state A, or we could transition to state B with some probability. So then the expected value is just the probability of going to state A times the expected payoff, plus the probability of going to state B times its expected payoff. Okay, now I'm going to claim state A has a positive expected value. Okay, and I'm just going to make that claim because we're at the top of a queue. It's a big queue that we're at the top of, and there's a lot of volume behind us. Okay, so there's a lot of buying pressure or a lot of support for my order. And on the offer, there's very little volume at 13 and 14. There's very little selling pressure or very little resistance. So it's likely that if this order got filled, we could subsequently see the price levels increasing. Okay, so let's assume that that's got a positive expected value in state A. Now in state B, I'm going to assume that this has a negative expected value. We're at the back of a queue. It's a small queue. There's very little support behind us at price 11. And there's a lot of selling pressure at 13 and 14. So it's likely that we could see the price pressure pushing that price down and this order getting filled and the price still going down and the order losing money. Okay, so that's kind of an assertion I'm just going to make for now, and I'll talk about that later. But imagine now that we want to work out the expected profitability in this initial state. It's the probability we go to state B times a negative expected payoff, plus the probability we go to state A times a positive expected payoff. So if there's a very, very high probability that we go to state B, this initial order will have a negative payoff because we have a high probability of going somewhere where we lose money. Okay, so the expected value of this initial state is negative. But what happens when we introduce the option to cancel? Okay, things can suddenly change. If we go to state B, we cancel the order. Zero payoff. We don't make or lose money. If we go to state A, we leave the order, positive payoff. So now the expected profit of this order has gone from negative, where we can't cancel it, to becoming positive when we introduce the option to cancel. Okay, and that sort of highlights the importance of canceling an order, how it can dramatically change the expected profitability of the order. Now, what I've done in this kind of simple example, I've made two big hand-waving assertions here. Okay, first, I assumed we can only transition to two possible states. Okay, in reality, we can probably transition to an almost infinite number of states. So to address this is pretty straightforward. We can just have a much bushier tree where we have a lot more transition probabilities available, or a lot more states available to transition to. The other hand-waving assertion that I made is I just said state A has a positive expected value and state B has a negative expected value. But this is purely an assumption, okay? And I don't actually have any estimates on these numbers. So the only way to solve this issue is to do the same thing for these states, for state A and state B, as I have done for this initial state. Okay, so we're going to need to grow that tree out and track these orders, keep growing the tree until these orders get executed. So we're going to grow this tree out, track the orders till they execute, and work out, once these have been executed, keep tracking them to work out which ones are profitable or not. Okay, once we've done that, we're going to back solve the tree up and to see if we go down any branches that potentially are going to lose us money, to say that we should cancel if we hit that branch, okay, where there's a negative expectation. So in essence, you can think about this as a dynamic programming problem, or similar to if you want to solve an American option, okay, where we backwards solve a tree for an American option to work out when is it early to cancel. Same concept, work out when is it, an American option, when is it early to exercise. Same thing, back solve, when is it early to cancel. So once we do that, we could have the expected profit of being in state A conditional on the order optimally being managed, and we can get out what's the expected profitability of being in state B conditional on it being optimally managed, and then it would be easy to back solve further up to work out what's the expected profitability of this initial state. It's just the probabilities of going to state A times the payoff plus probability of state B times its payoff. Okay, so that's kind of the intuition, hopefully, of how we think about managing the limit order. Okay, so if you want to sort of make that, that intuition a bit more formal, we can express that in the following Bellman equation, which is really core to reinforcement learning. Okay, so what we want to do is we want to be estimating, remember, that long run expected profit. And I called that Q score. So we want to estimate the long run expected profit if we're in a given state, S, and we take a certain action, A. That's what we're trying to estimate. Now, we can have two possible actions. We can leave the order or we can cancel the order. If we cancel the order, the expected profit is 0. So we'll focus mainly on the action where we leave the order. Okay, so I want to work out what's that profit for a given state where I leave the order. It's going to equal this. Let's focus just on the right-hand side over here because it very much follows the intuition of the tree I just described. It's simply all of the probabilities of the possible states we can transition into, what those probabilities are, times it by their payoffs. So when we look here, T is just the probability of transitioning from current state S to future state S prime. So we have that transition probability, and then we're going to multiply it by the long run expected payoff of being in that future state S prime. Okay, so probability times payoff, and we're going to sum over all the possible states we can transition to. Now, one little trick that you should be aware of there is I have this max A prime term. And what that means is when I move to this future state S prime, I'm now in a future state. I'm going to pick the action A prime that makes me the most expected profit in that state. So if I move to a new state where things look bad, okay, if S prime looks like it's going to lose me money, the optimal action would be to cancel the order where the payoff is 0. If I move to a state where things look profitable, if S prime looks like it would be good to leave the order, then the optimal action A prime would be to leave the order. Okay, so that's kind of explaining the intuition of the tree that we just described. Now, the other thing that needs to obviously come into play is as I transition from state S to S prime, I could generate some profit during that transition. And that could come from my order getting executed, where we make the spread, or it could come from favorable price moves if my order has been executed and I've got inventory. And that's what this term is going to do. It's going to calculate any immediate profits that happen during that transition from state S to S prime. So the key variables that really pop out of this are the states and the actions to define the problem. Okay, so once we've defined those states and actions, then the inputs required to estimate this are going to be the transition probabilities, those T's, and the immediate rewards. And we're going to estimate those empirically. Okay, so I'll just open up if there's any questions. We can try to sort those out. Bjorn?
Yes, thanks, Richard. Very interesting so far. So if I get it right, what you're after here is what traders should do rather than what they actually do. So one question is, then once you have established what they should do, will you be talking about inefficient, the amount of inefficient order submissions and cancellations that we see in the market? And I have another question. I'll ask that one right away as well. I think you said it is straightforward to specify the expected profit function, but does that mean you're ignoring private values that investors actually have a need for trading? Because then if you include that, I think it's pretty far from straightforward.
Yeah. So first question is, no, I don't look at how well traders actually optimally manage their orders. I'm just sort of purely pulling out these variables and then seeing how important they are if you were to sort of optimally follow this. And I don't consider any sort of private valuation. So I think the best way to think about this is if you're a high frequency market maker that just wanted to spray the book with limit orders that are going to generate you profit, where should you be placing them? And when should you be canceling them to basically have maximum expected profit?
Thanks.
Oh, no problems. Albert, I can't see everyone, so I don't know if there's a moderator that can see all the hands up. But
yeah, I see the hands. I'll tell you if you if you're missing somebody.
Thanks, Richard. Indeed, very interesting. You have a good way of explaining what you're doing. One thing that you haven't touched, which strikes me as important, is the latency at which I'm operating. In particular, when you talk about things like option to cancel, that is critically contingent on what latency you interact with the market. Because you might want to cancel, but you refresh your screen and your ability to cancel is already you're executed. So it sounds like if you're at a higher latency, your transition probabilities or your states are fewer, your transition probabilities are different. Is that I'm assuming that you're operating under zero latency assumption or something like that, or how should I think about this?
Yes, so I guess in this I've set it up so that there's a zero latency on the cancel. But you take a snap of the world every 100 milliseconds, if that makes sense.
Yeah, okay, thanks. I'll dwell on it, but that's what comes up in my mind when you go through this. I'll let the next one go. Thanks.
Okay. Jim?
Similar question. What happens if you add a tiny cost for cancellation to your analysis? Because it does consume computer bandwidth, there is latency, and some market platforms may penalize you for too many cancellations. So is that really going to affect your analysis?
I'd say at a high level, it's probably not going to dramatically change change the overall results. I've actually been thinking about putting in a bit of a cost to cancel recently, and re-estimating it with that cost. I haven't done it, but it's certainly been on my mind lately that making it a completely free option might be kind of a bit generous. So it's certainly something I've been considering. Okay, Cameron. Oh, yeah, Cameron.
Oh, hello. So I'm wondering about like kind of the optimality of Q-learning stuff, right? Because you have this kind of like partially observed Markov decision process. And I don't know to what extent market conditions could be considered Markovian, right? So do you have thoughts about like what happens if this is not actually Markovian and what that says about the policy function that you end up generating?
Yeah. So I think so. I have a paper that I published before in Journal of Econometrics that sort of tests that Markovian assumption quite a bit, and it seems that it's a pretty good way to model the book. That there is this sort of Markovian property. So I think with all these things, there's always a limitation, right? You're never going to get a perfect understanding of the world. But I think it's, from what I've seen empirically, it kind of holds up pretty well.
Cool. And then you can always just like hand wave and say, look, ML always gets pretty damn close, usually.
Yeah.
Like reinforcement learning doesn't tend to fall apart. So that's kind of like well, it does sometimes, but usually not in things that are like Markovian adjacent. So yeah, I just wanted to know, but thank you.
Okay, no problems. Jose?
Hi. So my question, I guess, is related in the sense that, I'm asking about what kind of, do you take into account any kind of market closing effects? And I guess that's related to the Markovianness in the sense that we understand that there is a time effect during the day, time of day effect. So are you accounting for that in any way? And a related question is, are you going to estimate this empirically on data? Because generally this is, understand from the math finance literature, this is a kind of standard optimal execution kind of problem in a Markovian environment. So you need the reinforcement learning because it's not kind of a closed form kind of setup.
Yeah. So first question is, I haven't got in this states considering the time of the day. It's probably something I can add at some point. You'll see shortly there's a lot of states. So I'm reluctant to put everything in just because it starts to fall apart. But it is something I could consider putting in. And then the estimation is done empirically. So I'll talk about how I estimate that pretty shortly.
Thanks.
Okay.
I don't see any more questions. I just wanted to let you know we're about more than halfway through the seminar. So I know you said it's after 15 minutes, but yes. So
I'm gonna pump it through. Okay, so as I say, 2 actions. We're going to leave the order or cancel the order. The 2 actions available, and the states that we're going to do to define the model. I'm only going to focus on modeling an order at the bid. Just for track, if you're going to solve it for being an order on the offer, it's the same. It's a symmetrical problem. And just to reduce the dimensionality, I'll focus just on having an order at the best bid, 1 behind the best bid, and 2 behind the best bid. Once you go 3, 4, 5, it's all very similar. So the states that are going to define the market for the limit order trader, we're going to have 5 variables that are public that everyone is aware of. Those are largely going to be Q lengths. So Q's at the best bid, 1 behind, 2 behind the best bid, and the volume at the best ask. Now, just for tractability, I'm going to discretize those into basically extremely long Qs down to extremely short Qs. So 5 possible values. Volatility is the other variable. To proxy volatility, it's hard to measure what's the volatility. I'm just going to use the last 100 trades, high minus low. Private market states are the states only the trader's aware of. We're going to have current inventory, which can be 0 or 1. Okay, so if it's a 1, the trader is long. The order's been filled. And once that order's been filled, they can't work any subsequent limit orders. So this is a way to just get the expected profitability of 1 order, not a portfolio of orders. If their orders not been executed or not been cancelled, then they're working their order and it could be sitting at the best level, 1 behind the best level or 2 behind the best level. Otherwise, it's been cancelled or executed. And the last thing to consider is that queue position. Again, I'm going to discretize that into 5 possible locations in the order book. At the top of the queue, all the way back to the back of the queue. So all up, I'm going to have 8 states that define the state space, resulting in 18,000 unique states. Okay, one thing to think about though is just note that these states aren't really assuming that that's what's driving the data generating process or the price generating process. Okay, this is just estimation of empirical data. In that empirical data, there's plenty of other moving parts. Okay, there's volume at all the other price levels that could be driving the price process. So I'm just looking at a snapshot of the variables that theories teased out as being important, taking a pretty small snapshot of the universe and then testing, are these variables important in that data generating process? Okay, so once we've got those states and actions defined, we want to now get the inputs, okay, which are the transition probabilities and the immediate rewards. They're the inputs we need to estimate to be able to solve what the expected value is. So transition probabilities are the first things we want to get out. So transition probabilities, we need a transition probability from state S to S prime. So if we have capital S states, we need an S by S matrix of transition probabilities. We also need that for both actions. Okay, we need it for the cancel. We also need it for if we leave the order. So these are just transition probabilities of the Markov chain. Very simple for a cancel. If we cancel, we move to a certain state with probability 1. If we leave the order, then the transition probability is a bit more difficult. We're going to get that out empirically. So just to give you an idea roughly of the structure, if we leave an order, okay, and this subscript 0 is the order hasn't been executed, the subscript 1 means the order's been executed. If we leave an order, then we're going to be transitioning from one state to a new state. The order's been unexecuted, and there's going to be some sort of, oh, sorry, this matrix is the wrong matrix. I'm going to apologize. That's sorry, that's for the immediate reward. I'll do it for a cancel. So if we're in a cancel state, we simply transition from state 0 to state cancel with probability 1. Okay, and if it was to leave the order, we'd be in a current state where the order hasn't been executed, move to a new state where the order hasn't been executed, and there'd be certain probabilities here that we need to get out empirically. Okay, so that's what we're going to have to tease out of the data empirically. Same thing for the immediate reward. We're going to have to capture any profit generated as we transition from state S to S prime, and that can happen in 2 ways. We can get it from execution, or we can get it from price moves with the inventory. So if the order executes as we move from S to S prime, we can generate money by making the spread. And that's what is occurring in this part of the equation. Or we can generate some profit by the midpoint shifting from S to S prime. Okay, so if we're carrying inventory, so that'll be a 1 if we're carrying inventory from S to S prime, otherwise it's a 0. So that's going to pull out any profit we get transitioning from S to S prime. Again, we're going to need a full S by S matrix for if we cancel the order or if we leave the order. Canceling is easy. It's just always 0. We never make money. But if we leave the order, that's going to require empirical estimation. Okay, so I might hold the questions to the very end just because I'm running out of time. So to get that empirical estimation, I'll go out and get sort of pretty granular data, every order, submission, cancellation, and amendment. That allows me to fully reproduce the order book. What I do is I then slice the data into 100 millisecond intervals. At the beginning of the interval, I've got a series of hypothetical orders at all the different levels in the order book and queue priorities. Over those 100 milliseconds, I then track those orders and I see which of those orders would have been executed and what the state of those orders look like at the end of the 100 milliseconds. And that gives me data where I know what the state of the order book is at the beginning of the 100 milliseconds. I know what the state of the world is at the end of 100 milliseconds and whether the orders got executed or not. And that's the empirical data that I then use to work out the execution probabilities or any profits that these orders would have generated and the transition probabilities. So I get that data and I plug it into the RL model and grind the handle to get out those the results, the expected profits. So if I was to just plot that, if I've got what's the expected profit of an order at the best bid, this is the full range of possibilities. So there's, you know, a bit over 5,000 states. This is the range of potential expected values that that order can have. As we go one tick behind, we see the range of potential values for all the different states compresses. So what you can see is what I was originally saying, how the further you move away, the tighter the range of expected profitability becomes, because these variables become less important because you've got time on your side. As the market moves towards you, Q priority could change. Okay, so we see that compression as we move further away. Okay, so probably to tease out more interesting stuff, if we look at something like Q size, what I'm going to do here is have the expected profitability of the order, and I'm going to regress it against the size of the Q at the best bid, 1 behind the best bid, 2 behind the best bid, and the volume at the ask, and then control with state fixed effects. So if you run that regression on my 20 sample stocks, what you see is for an order at the best bid, okay, the expected profitability goes up as the volume at the bid goes up, volume 1 tick behind, volume 2 tick behind. Okay, we see it goes up. Whereas if you're 1 tick behind the best bid and you rerun that regression on just the states 1 tick behind the best bid, what we see is that the expected profitability goes down. Okay, so what's that saying is, if you're 1 tick behind the best bid, the more volume there is at the best bid, the lower the expected profit of your order. Okay, whereas volume at your price level or behind you increases the expected profitability of your order. So what this top plot is showing is the more volume in front of you, the lower the expected profit of your order. The more volume at your price level or behind you, the higher the expected profitability of your order. The other thing that teases out here is if you're at the best bid, the more volume on the ask, the more likely you'll lose money. But if you're 1 tick behind or 2 ticks behind, the more volume on the ask, the more likely you're going to generate money. And that's because that volume on the ask is selling pressure. If you're at the best bid, there's selling pressure right there against you. It's going to potentially push the price against you and you'll lose. But if you're away from the best bid, that selling pressure is actually pushing the price towards you and increasing your execution probability. So it can be beneficial if you're actually far from the best. Volatility has also got a nice result. Okay, so if I run the regression on all 20 of my sample stocks, where I'm trying to see what's the importance of volatility, I get pretty mixed results. But remember that there are those two opposing forces. And when you bring in the fact that you've got a mandated 1 tick spread, you get pretty interesting results. So Mao Yi's got a lot of papers on sort of tick constraints, and there's a recent JFE there that really articulates this well. So imagine that the break-even bid-ask spread is this red line. People should post at that bid and offer, but they can't. So what they do is they tighten in. They have to post at the mandated 1 tick spread, the bid and offer, and they can easily generate profits. As volatility goes up, that break-even bid-ask spread should widen, but it's still within, it's still less than the mandated 1 tick spread. So if volatility goes up, you just lose profit. Here, the mandated bid-ask, the break-even bid-ask spread is smaller than the mandated 1 tick spread. So everyone posts 1 tick, we lock in some profit. But if volatility goes up so much that the break-even spread becomes wider than the mandated 1 tick spread, market makers would open up to a 2 tick market. And we can see then volatility goes up, profit would increase. Okay, and so what happens when I break my subsample up into the most 5 constrained stocks, all 5 of them have a negative and significant coefficient. Okay, so exactly consistent with this, when volatility goes up, they always stay constrained, profit goes down. And if I run that same regression on my 5 most unconstrained stocks, we find this result. When volatility goes up, profit goes up, or the expected profit of the limit order goes up. So you can see you get that mixed effect coming out in the data. The last thing, as I said, is that option to cancel. So the thing that you can do with this model is we can re-estimate that model where there's only one action, and that action is to leave the order. And if we leave that order, we now have a model where we can compare between the two models. We have a certain state where if we can only leave the order, we can't cancel it, we've got an expected profitability. And then we can also look at the exact same state where we could cancel the order in the future. And any difference in those two expected probability estimates is reflecting just the option to cancel. Okay, teasing that out, the difference shows that on average, the option to cancel is about 15% of the expected profitability. And in a quarter of those states, if you can't cancel the order, it's got a negative expected profitability. Introduce the option to cancel, it becomes positive expected probability. So you can see it becomes pretty important. And it's obviously heavily skewed towards certain market conditions, which is where you're likely to lose money. Okay, so that's sort of a big overview there. So as I say, the idea is to propose that machine learning technique, try to get out those expected profitability of every order if you're going to optimally manage it. And that allows us to sort of test those theoretical predictions on the empirical data where people might not be as rational as you kind of hope. And you can see some of those results. There's a lot of subtlety there. And there's probably a lot more I can talk about, but there's a lot of subtlety there, and also that ability to see how valuable is the option to cancel. Okay, so thank you all. I appreciate the time and the opportunity. So I'll open up for questions. Okay, Jose.
So, so thanks you for your paper. It's very interesting to see how you estimated the expected value of execution. Now, given that what you're doing, if I understand it correctly, is just give us an estimate of what the costs are using machine learning. It's a pure empirical exercise. My question is, to what extent should we take these results as reliable in other contexts? So what are the statistical properties, the confidence intervals of the things that you have estimated?
Yeah, so I think sort of it's as I said, I run those regressions to see how important these variables are. So there's kind of I guess then a regression done after the fact of estimating to see how important these things are. If I run these on the estimates on different subsamples, they sort of kind of consistently pop out on all the stocks, and the estimates are kind of pretty robust to what subsample of data I estimate, if that makes sense. So I can bootstrap out the expected value estimates, and they sort of come out consistently with pretty tight range intervals and statistical there. And then, as I say, running these regressions on each stocks individually, those coefficients of how important these variables are comes out. So to me, the results seem pretty robust and sort of hold up across the sample of stocks I look at. Hopefully that sort of...
You've tested it in sample?
Yeah, it's all in sample, but I've tested it estimated the model on 2 months of data here and estimated it on a different 2 months, and those coefficients coming out or the estimates are pretty consistent. It's obviously not an identical estimate, but it looks like whether if you estimate the data on July and you get an expected value of 1 tick for this state, estimated on August, you'll also get a similar expected value for that state. There's pretty good. The estimates from one sample to the next are pretty similar.
Okay. Thank you.
Okay, no problems. Albert?
Yeah, it's really cool. Lots of thought-provoking stuff here. A couple of quick questions. Did you run this at the HFT firm that you're working at?
As I say, it's been on my mind for 10 years. I never got to solving this.
They should hire you again.
Yeah, I mean, since I posted it, a few firms have reached out and...
I understand why. No, a bit more serious. There's work by Patrick Sanders who does dynamic program in the state of the limit order book, and he has all these kind of techniques to solve. So you might want to take a look at that and position it according, since you're close to that existing literature. I'm guessing you haven't looked at it yet.
Sorry.
Patrick Sanders, I think it's Review of Economic Studies, and from that you can probably find more. But the more concrete question is, you must have given quite a bit of thought on how to discretize the states, and I couldn't quite follow the logic on the way you did it, because if I understood it correctly, I made some notes here that you compute the queue lengths at the best 3 bids. And another one is to discretize where you are in the queue. But I guess for both of these, it depends on where you are relative to the midpoint of the market. Because if you're really far off, the best 3 bids mean a completely different thing when in a condition where the book has just been refilled and the best bids are close to the midpoint. And the same thing goes with the queue. I would expect that you're within 1,000 euros of the best queue, or 2,000 euros, or dollars, or Australian dollars, or further out. You basically anchor on actual value rather than anchor on where you are in the queue, because the queue might be tiny and it doesn't mean a lot when you're in the front or in the back, or it might be long and it means something different. And you could discretize the same way with money away from how much money is between you and the midpoint of the market. So that sounds like more appealing way to do it. But any thoughts there? Maybe it's a bit too detailed for because there's a lot of people waiting, on the back of the queue here. So you might not take all the time here, but just some things to think about.
Yeah. So with sort of the discretizing on the queue, like I agree that if you're at the front of a small queue or the back of a small queue, it's kind of irrelevant. But because the state space has your queue priority and the size of the queue, it captures, okay, if it's a small queue, that variable drops out to kind of not being so important for that state when the state's small and your top or bottom, those expected value estimates are very similar. And then when you move to a state where the queue is really big, and whether you're at the top or the bottom, there's a big range in dispersion between those expected value estimates, if that makes sense. So consider the scenario, you're in a small queue and the expected value when you're at the top of the small queue is 1 tick. The expected value when you're at the back of a small queue is 0.99 of a tick. But re-estimate that model and the state is a really big queue. You're at the top of the queue, it's 5 ticks. You're at the back of the queue, it's it's 1 tick. So it captures the fact that in that state space, you've got the size of the queue, it sort of captures that. And yeah, sort of the way that I think about, I agree that best bid, how you measure what's the best bid, I've been thinking about whether that's ticks away from the mid, or even is the best bid relative to the offer, right? So another way I've been thinking about it is, best bid is 1 tick away from the offer. Second,
I'm sure Björn has lots to say about this, his work on weighted with quote. But I see what you're saying. But it sounds like that it's kind of indirect and it's harder to parse the results than if you would do it more directly. But maybe it's a taste issue. But it's interesting.
Andre?
Yes. Hi, Richard. I think my question is actually related to Albert's. I was hoping to find out how difficult all of this is to estimate. I think you mentioned 18,000 state action pairs, right? So how difficult is it to estimate, and how difficult would it be to discretize in a finer way, sort of instead of 3 or 5 states, go to 50? Or to add more variables to the model? In other words, how flexible is all of this?
Yeah, I mean, it's a trade-off between data, computing power and time and these types of things, right? So it's certainly possible to put in more states or discretized to a finer level, that comes at the cost of obviously computer time. I'm limited to a desktop, so I sort of don't want to go down that path. But certainly, it's definitely possible to put in more states and tease out more. I sort of, yeah, as I said, look towards that theory, the theory papers to get variables that catch it then. And I feel at 5 levels, there's enough, there's enough difference between those states to really to see how important these variables are. There's enough granularity there. Whether if I change it from 5 to 10, I'm not sure that it gives me much more granularity on these states. If you're at the top and the back, that's clearly defined, and having the super top and the super back might not necessarily add that much more. But there's certainly, I feel at 18,000 states for the 3 months of data I've got is probably pushing the boundary of getting good, strong estimates out. So yeah, hopefully that answers it.
Yep, thank you. And does it take long to estimate?
Depends how efficient your code is. So my first crack at coding this up, it took a while. I've tightened the code a bit, so it's a bit better now.
Okay, thank you.
Richard, I'm not sure if I got it right. It was a bit fast at the data slides. But are the orders that you consider, are they hypothetical orders?
Yeah, and this is actually a very subtle and important point. So they are hypothetical orders, and the way to think about it is this is a hypothetical order of size 1, and it's not economically meaningful. And the reason why I went down that path, and this maybe comes back to Albert's question of did I do this at a HFT firm? If you start to use a real order and you submit that real order will change the state. And you could suddenly change it to be a really big queue, right? So you could say, I submit a big order with a big queue. And then what happens is that changes the state and everyone reacts as a result. And you end up converging to a situation where you could start spoofing the market, right? If you change this model to being, I can have multiple orders and I'm long, then the optimal action often is to submit a giant order to spoof the market to point up. So I sort of want to shut that kind of, let's say, illegal behavior down, and not consider your order having an economically meaningful price impact. So that's sort of the empirical thing there, is to say, well, let's just assume those orders are there and they were submitted a while ago and they're not economically meaningful, and then track them. So tracking. Oh, you go.
Yeah, this is exactly the discussion I was after, but I'm not sure which way to go is the better one, because if you assume that other actors, other market participants don't react to your order, then that's a big simplification. And then you can say, oh, let's think of a very, very small order. But you told me on my previous question that I should think about a market maker, and a market maker can be a fairly big player in an order book.
Yeah. And I think the other thing I should just preface there is the actions here are to leave the order or to cancel, right? It's not submit. So I guess it's sort of assume that order's there somewhere in the book, and the book has its current shape. So there's also, when I was talking about this manipulation, that's when you do something with an action of submit. In this case, the order we're going to assume has been left there. It's already there. The market's already reacted to its original submission, and now let's work from there. So there is a subtlety in that, and it's a pretty important subtlety. And I agree that depending upon whether you want to be working out, okay, the order's there, how much is it likely to generate, versus, okay, if I cancel and the world changes, what's going to happen?
So it would have been interesting. I don't know if you have in your data that you're able to track the one limit order and see what happens to it as you move forward in time. But if there are these insignificantly sized limit orders in there, then you could track it and see if if that gives similar results as hypothetical orders.
Yeah. I certainly could, and I'm pretty confident that they come out similar. I guess I spent a lot of time building a perfect simulator where you can simulate exactly where your order is in the queue, and knowing, would it have got the fill or not. So
Thanks.
no problem.
Jim,
Yeah.
before you
Just real
go
quick
ahead, I just
question.
wanted to say thanks, and that we'll be back in 2 weeks, but Richard has agreed to stay for a little bit longer, so we're not really in the rush to leave. But those of you who had to leave at noon, I just wanted to say we're not having a seminar next week, but we'll be having one in 2 weeks, and we're back with Jay Khan talking about disconnect between cash and futures prices in treasuries. And now, Jim, back to you.
Thank you. Just a real quick question, building on Andre's question. What kind of software packages are you using for this analysis?
I did it all in R, just because I learned to code in R before Python became popular. So, yeah.
Thank you.
No problems. Yeah, Andre?
There were also a few questions in the chat, Richard, that
okay.
I'm not sure if people would like to speak up, but I see also that some people say that the IO cannot work, but since you can see the chat yourself, I'll let you answer it rather than me.
Okay. Shall I go, Andre, and then I'll go through the chat?
I'm happy to yield to folks in the chat. So Katya, you decide, or Richard.
I'll let Richard decide, since he has the chance to pick the questions.
Okay. I'm gonna go. Okay, so Cameron, I feel I've answered this one, right, Cameron? Yep. Okay.
Oh yes, it's starting, and I think you just, I don't know if Jim, you still had the significance question, but it starts at John Roberts, and then I think you answered Mehmet, and so the first few have been answered.
Okay.
There was just a real quick question on the significance of those 0.01s. Now, of course, in microstructure, everything's significant, but I was just wondering, on the ask, it was a little counterintuitive to get a result like that. So just curious as to its significance.
Yeah, this came out significant for 19 of my 20 sample stocks, and in this case, 20 of my 20 sample stocks, and that 0.01 is the average coefficient. So there was some that are higher. And that 0.01 is the best way to think about it is this is expected value in ticks. So it's as you go through those discretizing levels, it comes up to 0.05 of a tick, which economically I see as kind of being relatively important. So this to me holds up, to be honest, and sort of checks out as being pretty important, in that those coefficients are sort of similar sort of magnitude as of other ones. So yeah, I feel it was significant and economically meaningful.
Thank you.
Yeah, okay, no problems. Okay, so there's this John Roberts. How you select this 100 millisecond rule. In futures, not a lot's happening. Yeah, so I guess there is a sort of an arbitrary choice of 100 milliseconds, right? And for me, the choice of getting that 100 milliseconds is, if I was to think about being permanently monitoring that order, I don't want to take a snapshot every minute, because a lot could happen in that minute. So I wanted to try to get that granularity down as low as possible. And the advantage for that is I just get more data, and I can get better transition estimates, transition probability estimates, because the state changes are always going to be, as you sort of say, quite marginal from one state to the next. Whereas if I wait a minute, a lot could happen. So I could get a very dispersed transition matrix, and maybe lose a lot of that granularity of being able to get in and cancel quickly and cancel early. So that's why I sort of chose to try to get pretty short intervals, to
Oh,
get
thanks.
good.
Thanks for that. I guess I was just more curious in terms of the estimation approach, if you were able to maybe focus on these bursts of activity, or what you kind of gain by having all of these marginal changes in these states in the kind of the approach, the analysis.
Sorry, can you just say that again? I just got sidetracked. There's a couple of questions popped up. It was.
Oh yeah, I guess I was just curious, since there's a lot of these 100 millisecond intervals, I imagine not a lot's changing, but you will see a few that have kind of bursts of this activity. I guess I was kind of curious. I mean, is it because you have so many that aren't changing much that the expectations don't change much, and so kind of the person is just allowed to kind of keep it in the book and not cancel it? Or could you actually run this, maybe focusing on just these bursts of activity and not worry about all of these intervals where nothing's really happening?
It's certainly a possibility. At one stage I was considering doing this state transition basically at an order level, right? Every time an order comes in, where do you transition? What does the state transition to? That became a bit too much for my computer to handle. So I said, well, let's take it down to 100 milliseconds, but maybe an alternative is not doing it every order level, but doing it every, 100 events, right? If 100 order events come in, track that. My feeling is you're probably going to get sort of similar estimates. Like, I agree that you'll have maybe less, I have quite a strong diagonal on those probability transition matrices, that if you're in this current state, you're likely to be in that same state in the next interval. Whereas if you did it on, maybe an event space, that strong diagonal might disappear. But I'm not my gut feeling is that that's not going to change the expected values at the end of the day. That you'll still come out with kind of similar results. Is that hopefully answers the question?
Oh yeah, thank you so much. Thanks.
No problem. No problems. Okay, so I have a question from Mamet. Are the regressions based on out of sample? So essentially what this is where it's all in this regard, it's in sample, in that for this data set, I want to work out how to optimally manage my limit order. To get that out, I'm going to get those Q scores out. And once I've got those Q scores out, let's see what's driving those Q scores. So, if I go to these regression, what is this Q score? What is this Q score based on these variables? So how much did these variables drive those Q score estimates? Okay, so it is in sample in that regard, I suppose.
And maybe
before.
Have you looked at the robustness of these transition probabilities? Are they kind of close in the out of sample data?
Yeah, so that's what I said. If I run this on 2 months of data, and then if I try to re-estimate this on a different 2 months of data, the results come out kind of pretty similar. So it seems pretty robust, that these estimates are kind of pretty constant through different periods. Okay. Can repeat about the rise in volatility. Yes, I can go through that one again. Okay, so when we look at the volatility, okay, so with the volatility, if we sort of assume that the break-even bid-ask spread, so this stock's really low volatility, everyone wants to really competitively post at the bid or the offer, and they would ideally post here and here to break even. And that's actually a lot smaller spread than the one tick mandated spread. So they actually post at the bid here and they post at the offer here. So they're going to generate a lot of profit. Okay, they can kind of extract a lot of rent because of that mandated one tick spread. And then as volatility goes up, the theoretical break-even bid-ask spread widens, okay, because the adverse selection risk goes up. So now they're going to post here and here. And that's still less, that break-even spread is still less than the mandated one-tick spread. So everyone is still going to post at the mandated one-tick spread competitively, and we see the profit decrease. Okay, so as volatility goes up for these constrained stocks, we see expected profit go down. But for the unconstrained stocks, mandated spread, the break-even spread is here, which is less than the mandated one-tick spread. So everyone's posting at the mandated one-tick spread and locking in a little bit of profit. But as volatility increases, it could be the case that it increases so much that the theoretical break-even spread is wider than the mandated one-tick spread. So if you were to post at the mandated one-tick spread, you're going to lose money. So everyone now posts and opens the spread up to 2 ticks to make money. And so when the volatility goes up, your profit can go up. Okay, so when I break up into those 2 subsamples of my highly constrained stocks, the most constrained stocks, the 5 most constrained stocks, if I run this regression, we see that volatility decreases the expected profit, exactly in line with that intuition. And if I run it on the 5 most unconstrained, we get a positive expected profit. So hopefully that's sort of the intuition there coming out from that. So hopefully that makes sense to you. Yeah, Albert.
Hi, I missed part of your seminar because I had another meeting I had to go to, but regarding what you were just talking about, I think the right way to think about it, it's not that adverse selection is a bit bigger when there's more volatility, even though you know, my own papers might suggest that, but rather that the tick size is more constraining when the volatility is low, and the minimum tick size is less constraining when the volatility is high. And it raises the question of to what extent the profitability of order placement strategies depend on how constraining the tick size is versus to what extent it depends on other stuff that might be going on in the market. My intuition is that when the tick size is very, very constraining, unsophisticated traders, you know, like a retail trader who's not paying that much attention is going to lose more on an order because they're going to you know, miss out front run and lose a whole tick, which is kind of more relatively speaking than if the tick size were smaller.
Yeah. No, I completely agree with that. And as I said, I think sort of there's a paper, Li Wang and Yi in JFE that really talks about this, kind of this scenario where basically everyone wants to race to be at the bid and the offer, because there's just, you know, in this scenario, there's so much money on the table that it's always constrained and everyone wants to be at the bid and offer, you know, and kind of the retail guys get crowded out, right, from that because they're just too slow. So I think there's definitely something there that, you know, this scenario here, you're gonna bank, right, that there's a one tick spread and you know that the price just isn't going to move all day. And if you can get to the front of that queue and stay there all day, you kind of print money. Whereas,
so when everybody's doing this racing, then I think John Roberts' point becomes very relevant, because what's going on is there are going to be certain subseconds, you know, maybe 100 millisecond period of time during which there are lots of events taking place where people are maybe racing to get a good position at a new bid or new offer, or racing to cancel, and you know, just lots of little things happening. And I guess your methodology is not looking at that racing that's taking place within the sub-second periods, but is assuming something that's kind of slower paced.
Yeah. I suppose the way to think about this is I'm not as fast as the fastest, right? I can operate around 100 milliseconds, and that's my speed. So yeah, I think that's probably a good way to think about it. Is, as I said, I could try to model it on every interval. I just don't have the data or the PC grunt work to do that. And if you're operating on that event level, then you could kind of be the fastest in the market. Way to think about this is I can't afford to be the fastest. I'll just do my best to participate. is maybe a way to think about it. Andre?
Yes, Richard. So I understand that the list of variables that you look at come from theory, but since you've worked with this model, I'm guessing, and applied it in to data, is there anything that you can see in the data that theory may be missing? In other words, have we got all of the important variables?
Oh, to be honest, I haven't tried other variables, to be honest. But I think these are the key things that, from my perspective, or my I guess my previous life's experience is, this is what you care. These are the key variables, right? What does the order book look like? Where are you in the order book? How volatile are things? If you're focusing just on the order book, obviously you could try to worry about where the futures markets are going, or what's happening in the option markets, and are people delta hedging. But if you want to close those channels down and just focus on the order book, I feel that these are kind of the key variables popping out in the theory.
So there is one more question from Stefan in the chat. I'm not sure if it's a question or a comment.
Oh, sorry. Yes.
He says that the audio doesn't work. So Richard, I'll let you read and comment.
Okay. If there's an upward trend in the price, the bid will not be executed, but Q will continue growing due to the inventory value, inciting the policy to keep the order there rather than cancelling. Have to be at the ask as well, and therefore, okay. So I think the subtlety, if I'm correct, what I've tried to do is model this so that you only ever have one order. Okay, so if you only have one order, once you get an execution, you can no longer have any more limit orders, and you just track the profitability of that limit order after it's been executed. So I'm thinking that addresses this question, is that we're just going to track one limit order. Once that order is filled, we can't submit any more. We simply just have a state where the inventory is long, and we just track any subsequent price moves generated that make profit for that order. So hopefully that answers that question.
Any other questions or comments? I guess it's now truly the middle of the night for Richard. So thank you once again, Richard, for joining us. Very interesting talk. Thank you all for coming. Thank you for questions, and we'll see you in 2 weeks.
Okay, thank you. Thanks very much for having me.